Morning, this is Manfred of Map Partners. What I would like to share with you this morning are some of my observations based upon the last 30 years of my involvement, both in professional and personal capacity in the fund management industry. Hopefully, you'll find them useful, in particular about the investment opportunities in the down market, where indices are red when you turn on the media, whether in the news or over the web. Losses are being run up. In short, the investment sentiment is very poor. What I'm going to cover in this short video are some of well-researched areas such as investment behavior and what we tend to call investors' long bias. It explains why we tend to be more interested in financial market when they are moving up as opposed to moving down. What I'm doing here effectively is laying down some groundwork for the rest of our series on how to make money in a down market, where we're going to talk about and share with some of our experience the strategies that we use in order to exploit such a challenging condition. So let's start. Be fearful when others are greedy, and greedy when others are fearful. I think most of you, whether you're financial students or market participant, would have heard of this quote from Warren Buffett. A bit of background here. What Warren Buffett is trying to tell us is to distinguish between price and valuation of an asset. It doesn't matter what the asset is, whether it's physical, like a building, a piece of land, or financial, stock markets, bond markets. What is key in making a return on your investment or not is to appreciate, at least to be able to tell the difference between price and value. That may or may not be the same thing. Price is what you pay for example, $10 million, $20 million for property in Hong Kong, or $69 or $135 that you pay for one share in Alibaba. Whereas value is subjective but quantifiable. In the world of financial market, value may mean intrinsic value of a business. That is how much a company is being valued in excess of its book value, by also taking into account of its profit, goodwill, cash flow, etc. Now let's take a look at this chart showing the S&P performance. The performance of the top 500 companies in the US every month over the course of the last 15 years. As you can see here at the bottom of the chart, it starts from January 2007 until October 2022. And the orange bars here, those above zero with the blue arrow pointing here, tells you that you have made money. And then you look at the orange bars with their blue arrow pointing upward. Anything below zero means that unfortunately you have lost money. But what does that tell us? This only tells us the price performance of the top 500 companies. What it doesn't tell us is the value. Now, if we look at the next chart, so the green line here tells us the valuation of S&P for the same period of time that we looked at earlier on, going back from January 2007 through to October 2022. Let's look at this chart in more detail. Amazing, believe it or not, the valuation of S&P 500 has not changed materially over this 15-year period. In other words, the valuation at the end of October of this year is more or less the same as it were back in 2007. Of course, there have been peaks and troughs. If you look at the chart, at its peak, the valuation of S&P was 31 times versus the trough valuation back at the GFC time, 2009, 12 times. So an increase of 158% over this period of time. So what does this graph tell us about market valuations? Well, before the GFC back in 2008, investors would have paid 19 times for every dollar of future earnings of the top 500 US company. Here is marked with black arrow. That equivalent valuation would have been on average 16 to 17 times a year early. Here in blue, what does that mean? It means that investors were prepared to pay 12% or 15% more in order to secure or chase the returns similar to those back in 2007. And we know what happened afterwards. As Mark Twain says, history doesn't repeat itself, but it often rhymes. Let's take a look at another chart which might better illustrate Buffett's point on value versus price. Here, what we've got in front of us is the S&P 500. The blue line is the valuation. The orange line is the index, i.e. price level of the S&P. As you can see, quite often they move in the same direction, and also they move in lockstep. For sure, there are periods whereby they don't. And if you focus on the returns post-pandemic, i.e. here, that has been highlighted with the rectangle. From trough to peak with 2020 hindsight, S&P 500 would have doubled its money from March 23rd, 2020 low, i.e. it would have been at 2,584 points, to its peak back in January 2020, the level was 4,817. If you look closer, valuations actually peaked in February 2021 at 31 times earnings, here illustrated by the green arrow, versus 70 times at the end of March 2020. So price so far has had a higher percentage move than the equivalent move in stock valuations. This just reiterates Buffett's points. Prices typically boil over when others are greedy, and we should be cautious for overpaying for an asset. When others are fearful, it may present a good value investment opportunity. Let's go back to the original chart. If we focus on the downside monthly returns, remember, those orange bars below zero. The past 15 years has shown us that investors would have lost money once every 4 to 5 months within a year. This damning statistic is true even if we roll back to a longer time frame, say to the 1990s. If we do a different take for your information, the equity market drawdown in the COVID was around 42%. It was 58% during the GFC time. So far, the current correction to the end of October was around 30%. So is this doom or gloom of Russian roulette? So in summary, I do apologize for laboring the point on differentiating between price and value. They are important in identifying opportunities in financial markets, whether they are rising or falling. In particular, any attempts to avoid any false signal to enter or exit markets, to add or trim position, to take profits or trim losses. In the future videos, we shall continue to explore the concept of long bias and its implications in falling market, and ultimately, the strategy we have used to make money in falling markets. If you do enjoy the recording, please sign up MAP's YouTube channel. Any feedbacks are welcome. Thank you.